I started my career as an apprentice engineer, and then I moved on to leave that after 6 years and go to university full-time to do a degree. I'd done City and Guilds, Ordinary National, all of that stuff the hard way whilst I was doing my apprenticeship and working for a few years. But I always wanted, I had this burning desire to be my own boss and do something for myself. But before that, I decided I was going to do the engineering apprenticeship and then get some business studies input so that I could understand the business side of it and do accountancy, economics, marketing to get the background. I then went back into engineering for a few years and quite quickly went up a few companies until I was headhunted by Coopers & Lybrand. Now this was all, in my view, foundation to doing something. When we were at university, you know, it's great to see the organisation that's here with SIE. It wasn't there when I was at university, and what we used to do is meet in the coffee shop in the Livingston Tower at Strathclyde University and talk about what we might do, a group of us, about what we might do when we left university. What kind of business could we get into? Now, we all left and went our separate ways, and I went back into engineering and spent 2 or 3 years there, rising through the ranks, and was headhunted by Coopers & Lybrand to go into what they call corporate care. This was going into work in businesses that were in trouble and needed turning round. So I was getting to apply my skills, both the practical skills I'd learned and the academic skills in real life situations with other people's money to see if I could improve the business. Now in doing this for a few years, I could see that Coopers & Lybrand were charging a lot of money for my services, and I wasn't getting paid quite so much. I enjoyed what I was doing, so I was putting in long hours. I was working till after midnight, many nights of the week, and I decided to go and do this on my own. So that was my first venture into working for myself. And it was selling my services as a consultant, a company doctor, to improve other people's businesses. But in working on my own, I decided that what I needed to do, the best way for me to get into a business of scale, because I was very keen to be rich quickly. I didn't want to hang about, so I thought a good start would be to get a platform company and then build on that company. So in 1992, I bought into my first company, but to get the money for that, what I did was with my services was I charged a small fee, but a share of the upside. I had done several turnarounds, and I could see that there was a big improvement in the businesses from when I went in to when I left it. And my last job as a consultant or a company doctor was the one that really helped me build my capital base to buy into a small company. I started out with a company called Hunting Oilfield Services in Aberdeen. It had been insolvent or declared insolvent. The parent company were told to close it down, write off 15 million, no chance of saving it. Now, this was unacceptable to them, so they approached Price Waterhouse, the insolvency partner there, and asked him if he knew anyone who might be able to turn it round. Now, I had a look at it and I thought it would be dead easy to turn around. I couldn't see what the problem was. So I got a small fee negotiated and a very good deal on a share of the upside every year. It was losing a lot of money. Even if it lost less money, I was getting a share of the improvement. And after 3 years doing this, they wanted to buy me out of the, it was actually after between year 2 and year 3, they wanted to buy me out of the agreement because they said it was getting embarrassing, the amount they were having to pay me. So they bought me out. I bought into a small company with the money, and I bought a Bentley Azure, which I'd seen in a photograph in a magazine, and it was one of the first out, dream car, and I was off and running. But to buy into my first company, what I did was I had set out sort of criteria of the kind of company I was looking for, the size I was looking for, And I'd said I wanted a company that was turning over at least 10 million. Maybe not doing so well, because then I could buy it cheap. Now, I went about seeing the big accountancy firms, banks, and telling them what I was looking for, just the criteria. I wanted to stay in the kind of industry I was in, you know, engineering. I didn't want to get too far off beam there. And this company, Clyde Blowers, came up several times. Now, Clyde Blowers in 1992 was turning over £3 million. I thought it was too small, so I refused it twice. It was losing money. It was losing about £250,000 a year. And when it came back the third time, I thought I would have a look at it. Now, the reason I didn't want to buy one so small is when I was in doing turnarounds in companies, I found that very often you had to cut out some of the non-profitable business and focus on an area that was maybe a smaller business before you grew it again. And with 3 million turnover, I reckon there wasn't much to cut out. You didn't have enough space. But when I looked at this company, it was listed on the stock exchange, still run as a family business. It had been listed for, I think, tax purposes. It was run as a family business. The owner, chairman and chief executive was 87 years old, still running it on a day-to-day basis. It was one of 8 in the world doing what it did. And it was the smallest. It had the worst technology and the oldest workforce. The chief engineer, I think, was 82. And, but I saw it as a really good platform to buy into. My worry was that I would have to cut back and I wouldn't have the cash to grow it. But when I went to look at it, it actually had 3 industrial buildings on the site that it was on up in Clydebank. And all round about it, they developed a retail development. So I asked the gentleman that I bought it from why he hadn't sold it. He said, "Well, my father and I built this company and all these buildings. I'm not going to sell it to these retail developers." Now, I wasn't as emotionally attached to it, so I did some groundwork and found out that maybe I could get 3 or 4 million for that. And then when I looked at the company, in the good years, he had bought shares in the stock market through the company, so there was a share portfolio there as well, and that was worth 2.5 million. And all of this was kind of hidden. The stock market value of it was 2.2 million, and it was I had to value it at 3 million to get the business, and I bought 29.9%. So I had to get £1 million to buy into this. Now that might sound a lot of money to you sitting here, but I borrowed 800,000 and I paid that 800,000 back within a year, and I owned 29.9% of the business, and I was running it in charge, and I was able to grow the business. Just before I go on to how we grew it over the following 5 years, during my time up at Hunting in Aberdeen, and through the final year that I was there, I saw a house come up for sale. I just bought a new house and spent a lot of money on it doing it up. It was just finished. And then a house came on the market that I used to cycle past as a boy. And I'd see the owner going in with his chauffeur and his Rolls Royce, but I could never see up, and I was always very keen to see it. So I said to my wife, I'm going to have a look at this house because I've always been intrigued. I remember, as a small boy going past it, and she said, "Well, I'm not coming up. Don't be stupid. We've just finished this. There's no way we're buying a house." So I went up to look at it, and when I went in the gates, I thought, "This is my house. I'm going to buy this." It was a nice, fancy brochure because it was a very expensive house, and I left the brochure down on the table when I went back home, and I said to her again at the weekend, "I'm going back up to have a look." She said, "Well, okay, I'll come with you, but you're not buying it." And when we went in, had another look round again, the seller at the time, he said, "Well, what do you think?" She said, "Oh, he's going to buy it," because it was just, it was just a stunning house. But the problem was I didn't have the money. I couldn't afford it. No way could I afford this house. But I was so taken with it, and this would probably be at the beginning of the year. We'd set the budget for hunting for that year. I knew I got a share of the upside, so I went back home and I calculated what the profit would need to be to allow me to buy that house after the end of the year, when the bonus would be paid. And it was quite a bit higher than the budget that they had for the year. So the next day I went up to Aberdeen, I got all the management team in, and I said, we're going to have to revise this budget. This is the new budget. And we're going to achieve that this year. And I really focused hard on it. I had been into books on positive visualization, all of the books like Think and Grow Rich, and I was really into the affirmations, putting the pictures up of what you wanted in future, your dreams. So I did this with the house. Every morning and every night, morning and night, I meditated before I went to work and before I went to sleep. I went through the brochure. I'd already gone through the house several times and, could feel the fabric. So I went through that and got all the feelings. So I was living in that house for 9 months before I went in. And I went back and said, I said to the owner, look, I'll buy it, but I need 10 months entry date. And he said, well, that's fantastic, because I'm going to move to Australia. And I haven't really started looking for a house because I need to know that I've sold this before I do it. So we agreed the deal, and then I set off to achieve this budget, which was way above. Now, we actually beat the budget that year, but I focused on that every day intensely for the full 10 months. And it was just incredible how easy it was. Things happened because I was really absolutely passionately focused on it. And it was the same with the Clyde Blowers business when I get into it. I still live in that house and I still use that technique, even if I'm going, it's tough now with the banks, but before the banks get into their troubles, I used to go through, if I was going to go and borrow a big sum of money, the night before I would go through mentally what I was going to say. I'd walk into the bank manager's office and see him nodding his head and saying yes. So by the time I got there the next day, he didn't know it, but he was about to agree to what I was asking him to do. Now, in Clyde Blowers, when I went in there, it was the smallest of 8 in the world. And I thought, well, we need to get up from 3% market share to something between 15 and 20. That would be a good share, and I could build real value in the business. So I started talking to every one of the 7 competitors. I went to visit them. They were in America, China, Russia, Germany, to tell them my plan. And over the next 5 years, now this is just a short history of the company. When I bought in 1992, we bought over 5 years all of the competitors except one. So I went to see them, I got to know them, I'd have a coffee regularly, talk to them, win their trust, and then I thought I would convince 1 or 2 to sell to me. Eventually I convinced 6 out of the remaining 7 to sell. I had to leave 1 competitor because it wouldn't have been allowed to take them all over. But we went from 3% market share to 60% market share in 5 years. And it was all textbook stuff. Did the management buy-in, acquired the first one the first year after, and then established a venture with our Chinese competitor. And that was fairly out there. In 1996, we started talking to them in 1993, and people weren't really doing deals like that in China at the time. And then we acquired the second biggest one in the market, who'd already been competing with us, and they had acquired 2 of the others that I was going after, so I got 3 in 1 there. And then we acquired the last one. Now, this was the first one that I approached, and it was owned by a company called White Consolidated in Sweden. They wouldn't even take my call. They wouldn't speak to me because I was too small. And eventually, it was bought by Citicorp Venture Capital, who were competing with me to consolidate this industry sector. And I beat them every time because I would go and see people. It didn't matter if it was the other end of the world. I would go and see them in a heartbeat. And I would do it for one day and come back. And I would react quickly. I could tell, I could make the decision, are we going to buy them? How much are we going to pay? So at the end, they came to me with their hands up and said, okay, you've beaten us in every deal, you'll need to buy our company now. So eventually I got it. And they weren't able to compete with us just because we were so focused, so passionate, and absolutely believed in what we were doing and used these techniques that I used to buy the house. So they had no chance of beating us. We put 7 companies combined into one, world market share greater than 50%, that's now 60%. Still own that company, and when I started, it was turning over 3 million, I told you. Today, that was roughly $5 million. Today, we've got it registered in Delaware in the US, and it turns over $500 million. And we've added on, when we consolidated that industry sector, we then looked at complementary products and services that we could add on to it to expand the goods and services we were supplying to our captive customers. So that was, you know, it was thinking big. And I remember going through this in the early stages. A colleague that was working with me as managing director of the company, you know, I kept pushing him to raise his sights. You know, we heard earlier on, you know, don't let a glass ceiling stop you. Think big. One of the biggest problems we have is we think too small. He said to me, you know, Jim, the difference between you and me is you can dream and have a vision. I've got to deal with reality. Now, my answer to him, or my question to him was, what do you think reality is? The way you've described it to me is you're taking guidelines and rules and constraints that someone else has put out there, and you're quite happy to accept them as reality. My reality is what I'm telling you we're going to do. Now, he couldn't get this company beyond, it was loss-making for a good number of years under him. And you know, we did all the textbook stuff that you learn at business school. You know, after my bachelor's degree, I did an MBA, and then I did a second master's degree in international finance and accounting. I wanted to be the smartest guy sitting around the table when we were doing these acquisitions. Now, when you look at what we did, it was losing money. We kept buying businesses and kept losing money for 4 years. You know, so you have to, if you've got a belief in what you're doing, you really have to stick, you know, you've got to check it if it's not going right, but if you really believe you're doing the right thing, you've got to drive it forward, and you've got to have resilience and tenacity to drive your idea forward if you really believe in it. Now, by this stage, I was having to go to the stock market to raise money to buy the other companies, you know, and you saw in 1996, I bought the second biggest one in the world, and it was based in Germany. It was 6 times our size, and he was losing money as well. So I was getting real pushback from the bank because I wanted to raise money from them, and they said, wait a minute, you've done all these acquisitions, your losses are going up, and you want to take over a German company, and it's 6 times your size and it's losing money. So I had the plan all laid out, and I went through it. And fortunately, the CEO of the Royal Bank at that time asked to see me on a Sunday morning for lunch at Queen Street, the hotel next to Queen Street Station. And he said, look, I'm getting really strong push from my directors to support you here. But he said, I can't understand how you're going to make this work. Can you convince me? So I did, and he gave us the money. And now my strategy started to pay off immediately. The profitability kept going up and up, and that gave us a lot of credibility. But it was a real fight, and there were many times earlier on where people were saying, you know, do you really think this is the right thing to do, always questioning, and at many times I was just on my own in a dark room asking myself the same questions, but I was absolutely convinced and passionate about it. And it doesn't always come immediately. I get lots of younger entrepreneurs coming to me, and they think that after spending an hour, I'm going to give them some magic bullets and they go away and become a millionaire overnight. It's hard work. And we've seen that with people that have been up before. There's, working 3 years without a holiday. Now, that's where we were in the early part of 2000. In 1999, I took the company private. I took it off the stock market. Again, this was a big challenge for us. In 97, 98, there was a financial crisis in Southeast Asia. Our stock price, or the share price, went down to 25% of what it was, reduced by 75% within 3 months, even although the profitability was going up very strongly. Now, at first, your ego's hurt when you see that, and then you decide, well, just get the head down, we're doing the right things, it'll pass. But customers were phoning up and saying, there's something wrong, someone knows something that I don't know, because your share price is quartered. And I started thinking, this could become self-fulfilling. If people don't give me orders because they're worried, the company will shrink and the profitability will go down, and then some smart ass in the city will say, see, I thought you were taught about efficient market theory at university. Problem is, the markets are very often, and you've seen it recently, grossly inefficient. So I decided I had to take this company off the stock market, take it private, and that's what we did. We borrowed money from the bank, and also we got 3i in as an investor, and took them out 2 years later in 2001. Now, at the end of this, I thought, okay, I've got a group that I've built up. If I want to make a lot of money, which I do want to do, how do I get that cash? I'd have to sell the company and then start again. So I thought my model then was to build up a portfolio of companies, each with their own financing, build them up over 5-7 years, sell them off, and bring another one in at the beginning. So I reckoned if I had 7, every year I would be getting a big capital gain, and I could do those nice things that the entrepreneurs, not for 6 months, because believe me, you'll never get there. You'll go on holiday and then you'll get the itch to come back and do the next stage. So we took this private, and with the idea of splitting it up. The maximum I could get to was 3 businesses, because I had co-investment partners in each one. We would always try and take the majority, but I had a co-investment partner in each business. Each one wanted 100% of my time on the business they were invested in. So they were kind of constraining me from growing. So I then thought that what we have to do is create a private equity fund. And that's what I did. Went out to raise money in a fund. Now, I don't know if you're aware of private equity. This was just looking at a different way to fund the business. You can either do it privately. If you want to scale things, you need to raise outside capital. You can use the stock market, but it's inefficient. And when the stock market's down, that's when there's a lot of bargain opportunities about. But you're stuck. You can't buy anything because you can't tap the market for the money. So the next idea was move on to a model where I raise a fund from private investors and I invest that fund in 7 different businesses alongside our money. And that's what I've done. We're now in Fund 3. But we got up to 3 businesses. In 2007, the company that I served my apprenticeship was going to be sold to a Swiss competitor. This is Weir Pumps out at Cathcart. They were going to close it, pay off 550 people, and this iconic engineering company that's been there since the 1860s was going to be dead, gone forever. Now, I muscled in on that deal and I actually won it. I bought the company for 48 million. Between 2007 and last year, we grew it from 68 million turnover to over 400. we grew the profitability from 4.2 to 55 million, and I sold it in December to a company in America, SPX, for 750 million. So there's a very nice value creation opportunity there. But that company was the last one that I bought on my own. When I say on my own, I had 3 other partners. I would fund 60%, 2 of them would do 15%, and 1 did 10%. And that was the last one that we did as a separate business. Since then, we've been building a private equity fund, and it's a fantastic model. Before I was working with co-investment partners, they were getting a free ride. They're getting a big upside. So like the consultancy business, I started thinking again, how do I get paid for this? They're getting a free ride. So I now get paid 2%. Well, on Fund 2 that I did, I get 2% of a 250 million fund just for looking after their money. Now that's 5 million a year. It's very, very good income. And then you get 20% of their upside. So whatever gain they get 20% of that, and you get your own upside as well. So it's a fabulous model. Our latest fund is 420 million. We've still got the 251, and we've got 2.25% of that for managing it. So we get an extra 9 million for managing that. And that's something that we weren't getting paid for before, and we're getting 20% of the upside. So, and we're out there buying businesses, investing our own money, and we can tap into these funds when the market's down, when there are opportunities about to buy up good bargains, and we've got complete control of it with these funds. Once they're called blind funds, once they give you the money, you can do what you like. They're not allowed to interfere. Their only redress is if you mess it up, you won't get any more from them. So we've built this business up. Turnover today, it's got about 6,000 employees now. We've just bought a sizable business in Finland out of the Finnish equivalent of Chapter 11. We paid 100 million euros for it. We didn't take any banks in. We'll get them in later on, but we have the cash, so we'll buy it. Then we'll negotiate with the banks. We'll say, look, if you want to come in and lend us some money, bid for it. You're then not under the pressure of a deadline of doing an acquisition, and they've got you. You've got them now, and we'll be able to put some debt capacity into that. Our goal is to make 3 times the money that we invest in these, we buy the businesses for, and to do that in a 3 to 6 year period. And that means on a 420 million fund, if we get 3 times, the upside there is 840, and we get 20% of that, and that's alongside our own. And if you can keep repeating that and doing a good job, that's our sustainable model for generating wealth on a regular basis, being able to go away in your private jet to these sunny places at the weekends, every weekend, and not the 6 months, because then you'd miss out on the opportunity to continue this wealth creation. So that's a quick run through my history and what I'm doing. I know it was billed as someone that's already there. I believe I'm just starting. I've got a plan now out to 2031. That's when I'm going to retire, and I know exactly how much I'm going to retire with. So quite happy to take any questions.